It is Tuesday, the 18th of February, 2020. This is David Gauci. Dave Nagel and I welcome you to the 14th talk in the Business and Energy series of Forum 2100. Today, our guest is Dan Feldman. Dan has had quite an interesting career. He is more than simply an entrepreneur. He has served in senior management positions in a variety of energy enterprises in Lithuania, in the UK, in Russia, in Kazakhstan. He's also been a senior executive at a fantasy sports gaming platform in New York. But his career was really launched when he served as a senior attorney in the enforcement division of the SEC. There is much more to report about his entrepreneurial background, such as selling hot dogs at Fenway Park in Boston, but I shall leave it to all of you to visit the Forum 2100 website to read about this interesting man. Today, Dan is going to tell us about his startup, Search for Power. There are probably three key aspects of his story for you to follow. The first relates to cryptocurrencies and specifically to Bitcoin. The second relates to defining a business opportunity in addressing a specific environmental hazard. And then the third is just his experience of the highs and lows of being an entrepreneur. Dan, we welcome you to Forum 2100. For the next 18 minutes, the floor is yours.
Thank you, David and David, for this opportunity to speak. Venture capitalists often ask entrepreneurs, what problem are you solving? Well, my startup aims to solve two problems with one solution. Oil fields produce natural gas as a byproduct of the drilling and lifting process. This gas is referred to as associated gas. For decades, if not a century, the oil industry has burned the gas as it reaches the surface. This, as you may know, is called flaring. The oil industry will tell you that this is the most environmentally friendly way to get rid of the gas. What does that mean? That means that the gas, which is mostly methane, CH4, is an incredibly potent greenhouse gas. But by burning it / flaring it, the emissions become carbon dioxide, which, while bad for the environment, is less bad by a factor of 86 than simply releasing the methane into the air, which is called venting. Flaring gas is an incredibly common occurrence. Last year, $68 billion of methane was flared globally, 3.5% of the world's natural gas. 140 billion cubic meters of gas, 350 million tons of CO2 emissions. Big numbers. The flares are so large that in some cases, they can be seen from outer space. I've stood below huge flares in Western Siberia that undoubtedly could be seen from outer space. If instead of flaring, the gas was captured and utilized, it would be enough gas to power all of Africa. The top four flaring countries in the world: Russia, Iraq, Iran, and the United States. Why isn't it captured and used? Well, it's faster and cheaper to burn it. The oil is worth 30 times what the gas is, so the oil company is focused on spending capex on the oil and not the gas. Oil fields are often in remote areas of the world, Siberia. We're building a wide mouth pipeline for gas would be too expensive, and other egress options for the gas are equally uneconomical. There's a good example in the United States of this. North Dakota flares a large amount of gas. Why? Well, population is sparse in North Dakota, so there's no local use for the gas. The closest place that could use the gas would be Minneapolis, Minnesota. Well, the two options for getting the energy or the gas there, one would be, again, the wide mouth gas pipeline, but that would cost billions of dollars to build. The other would be to build a power plant and send the electricity across the power lines to Minnesota. However, with dissipation, by the time it got there, you're looking at 30 cents a kilowatt hour for the end user. The average cost for electricity when you turn your lights on in the United States is 13.7 cents. No one's going to pay 30 cents a kilowatt hour. So it's uneconomical. And as a result, they continue to flare in North Dakota. There are World Bank initiatives and big oil company pledges to reduce flaring. Sounds good. Sadly, the opposite is occurring. Flaring and even worse, venting are on the rise. In fact, it is generally accepted that both are underreported. So flaring is the first problem I want to solve. Problem number 2, Bitcoin mining power consumption. First, a quick mining 101. Every 10 minutes, one computer in the world is given a block reward of 12.5 Bitcoin. It used to be 50, then it dropped to 25 Bitcoin, then 12.5, and in May, it will fall to 6.25. Each of these events are called halvings or halvenings, and they are programmed to occur about every 4 years until the last Bitcoin is mined in the year 2140. Only 21 million Bitcoin will ever be created. About 18 million have been made already. It is assumed that about 3 or 4 million have been lost and will never be recovered. As a side note, if you've not read the Satoshi white paper on Bitcoin, you should. It's a quick read, 9 pages. There's no excuse not to read it. Some of you can read it on your way home today. Bitcoin, as I said, is given to one computer that is building every 10 minutes, the block reward is given to one computer that is building the Bitcoin transactional log or blockchain. Each transaction is encrypted. Each transaction gets added to a block. Every 10 minutes, the block with a certain number of transactions, the maximum number is about 2,700 of them, is added to the chain. The computers, which are all single-use computers with only one chip in them, try to be the first to solve a very large equation to get the reward. Verify that transactions are real and keep the process going. It is super compute heavy. 70 to 80% of the cost of Bitcoin mining is the cost of the electricity needed to power the mining computers. Bitcoin miners use more electricity than all of Switzerland, than all of Ireland, more than 159 individual countries. And the use is increasing rapidly, which is transparent on the Bitcoin blockchain, as you can see how much compute power is being used at any given time. As a result, miners are constantly searching for cheap electricity. For example, many miners migrate to the Sichuan province in China for a few months a year. Why? To take advantage of the cheap hydropower available during the wet season there. They migrate there, taking millions of dollars of computers with them, taking those computers offline during the move, and taking the inevitable breakage that occurs during moving as a cost, because the access to cheap power for those few months is worth it. Hydro-Quebec, using power from Niagara Falls, had to limit the number of miners using their powers, as if they did not, all of the demand would be filled by Bitcoin miners. They would use all of the power created by Hydro-Quebec. Plattsburgh, New York has a similar problem and has had to create a similar quota, limiting the number of miners using the power they create. There are 280,000 Bitcoin transactions daily. Each averages 922 kilowatt hours of electricity, equal to the power it takes to run 31 homes for a day. Bitcoin's annual carbon footprint is almost 36,000 kilotons. It's a huge number. As the price of Bitcoin goes up, more miners mine. As Bitcoin falls, the need for cheap power increases. At 5 cents per kilowatt, it costs about $5,000 to make 1 Bitcoin for a miner. Bitcoin is trading just under $10,000 a coin now. So miners are running as fast as they can, making something for 5,000 or less, and seeking to get as much of as many Bitcoin worth around 10,000 as a reward. And they're searching for as much power as they can get, because the more power they can get, the more computers they can run. Peter Thiel, the famous investor, was recently the lead investor in a $50 million raise at a $200 million valuation for a vertically integrated wind farm to Bitcoin mining startup in Texas. So those are the two problems: flaring and the need for power for Bitcoin mining. So what is my solution? I want to bring the use to the power rather than the power to the use. I'll say that again. I'm bringing the use to the power, whereas typically we bring the power to the use, right? We get power delivered to us, to the factories. So here's the idea. You drive a flatbed truck with field gas generators, maybe made by Caterpillar, right next to the pad where they're fracking or drilling for oil, and where they're also flaring. Next to the flatbed truck with some field gas generators, drop a shipping container full of computers right next to it. Turn the flare sideways into the generators, make the electricity, and plug the computers in. This will reduce emissions by around 80% and create electricity for the mining at between 3 to 3.5 cents a kilowatt hour. It will also move a cost on the oil company's balance sheet over to the profit side. That's the idea. It's pretty basic. And I should be attracting ESG investors. ESG investors are investors looking to make some kind of environmental, social, or governance impact. I should be attracting energy investors and tech investors. Should be easy. Well, it hasn't been. Initially, I thought I had an original idea, but now Crusoe Energy has run far ahead of me. They've raised about $75 million now, including a $40 million line of credit, on the same idea. They have a few pilots up and running. But this isn't a bad thing. It demonstrates that this is a viable business, and there's room for way more than one winner here. There's just so much flaring occurring. Bain Ventures, Founders Funds, and the Winklevoss twins have led the funding for Crusoe Energy. However, I still haven't raised any money. I've had a lot of good meetings, both with investors and eager to sign up oil companies. Lots of good feedback. And this isn't my first startup. I've done it before. My last startup, I raised $7.5 million. Wasn't easy, but also wasn't nearly as hard as this has been. Unfortunately, my last startup was not a success. And that creates two issues for me. And it could be why I'm having trouble today. One is I'm reluctant to go back to my seed investors / family and friends as I lost their money. So I don't have that resource to get the fundraising going. It makes the vital first step that much more difficult. Two, it creates execution risk concerns. I think investors looked at I was unsuccessful in my previous startup, and maybe that has a chilling effect on my ability to raise now. So I have to look in the mirror to try to figure this out. And I'm still trying. I believe in this idea. The first investor is always the hardest. I continue to get good feedback. I continue to have interesting meetings on the schedule. I'm improving my team. And in trying to decrease the execution risk concerns, I'm looking to add a petroleum engineer to my advisory board. I hope you have found this interesting. I'm happy to take questions. And of course, you're always welcome to email me directly at daniel@searchforpower.io. David and David, I think that's what I have. And thank you for listening.
Thank you very much, Dan. We have a number of questions for you, and we'll try to take them here in some order. A lot of questions about cryptocurrencies and Bitcoin in particular. Can you maybe elaborate on why some people value Bitcoin, and let us know perhaps who they are and why normal money isn't good enough for them?
Good question. So I think of Bitcoin as digital gold. A lot of people use gold as store of value. In countries where you don't trust the banking system, you don't trust the currency, and there are government concerns that make it difficult to flee at a quick basis, a quick short notice, and take your assets with you, I think Bitcoin trumps all other forms of store of value. You can leave a place quickly. There's no inflation or very little, and I think that alone, the ability to leave a place quickly, adds tremendous value, especially over gold, where you'd have to, how easy to take, a few bars of gold with you somewhere, not easy. Whereas you can leave with a small thumb drive in your pocket, or just remembering a 24-word key, and take your Bitcoin anywhere in the world quickly.
Okay. So a follow-on would be then to connect it to energy. How's Bitcoin mining normally powered? And why are the requirements so high? So is Bitcoin supply constrained by access to low-cost energy, for example?
So the solution that has to be solved to create the the new Bitcoin there's a difficulty rate to it. And the way the program works is that the reward is timed, so it should last about every 10 minutes. So the more competition for the block reward, if you want to keep it being distributed every 10 minutes, you have to increase the difficulty of the equation that's going to be solved. So that the computers still need to take 10 minutes to solve it. And so as that happens, the more compute power that's needed, the more electricity that is required to solve those problems. And with so many people competing for it, they're searching for power everywhere. I mean, in some countries you have cheap power, you can just plug it in, but other people go to Iceland, they go to China, they negotiate deals on a wholesale basis with towns and municipalities around in America, in Canada. And I think it's going to create, like you see with Peter Thiel, people creating more green energy. Peter Thiel is creating a wind farm that's specifically going to be used to power Bitcoin. He's not creating; he's investing in a company that's doing that. You look at Crusoe Energy, making use of gas that's just flared. There's a ton of it. I think you'll see other green energy with solar farms promoting the creation of those to power Bitcoin computers.
So, but there are other forms of cryptocurrencies, I believe, and that are somewhat similar to Bitcoin, but maybe different in terms of what do they call it? The consensus algorithm that's used as it consumes so much energy. But so can some of these other offerings benefit from using natural gas that would otherwise be flared, much as you have described here? And if so, how big is this market, and how does it compare to the Bitcoin market?
Yeah, so I think some of them are proof of work or proof of stake. So there's different ways to create the new coin. Some coin is not created from mining; that there's a central repository that kind of distributes it out to the people who are running what's called the blockchain nodes. The thing with Bitcoin is that the adoption is so much greater than anything else, that miners can kind of know exactly what their returns are going to be. It's predictable, because what you do is you join a pool, and the pool, anyone in that pool receives that once every 10-minute reward. It's shared by how much compute power you're kind of providing the pool. So there's a predictability to it. The price is kind of high enough now to support the spending of the money on the electricity. Others, I think there's not as much competition, and you can probably just run your computer at home to run, or get some kind of card that would help you run from Monero. You can run Bitcoin Cash, I think, on the same ASICs, the single-use computers that are used to mine Bitcoin. Again, I think because of the lower adoption rates for the other ones, the spending of the CapEx to build a mining farm, to buy the computers, which cost $2,000 a piece, people are hesitant to really put a lot of money into that when the adoption is so much lower on the others.
So that actually introduces another issue, which is since Search for Power is in business to save energy by using natural gas that otherwise would be flared, so that eliminates the need for other power sources. But are there any field constraints or thresholds that of availability of the resource that need to be satisfied in order to really have a viable Bitcoin mining application?
Yeah, so for when you're dealing with field gas or associated gas, it's typically flared. If I'm focusing now, I'm looking at Canada, and a lot of the mining, a lot of the oil exploration in Canada is fracking. So fracking, each site has about a 400-day life cycle. So you couldn't build a really large mining facility when you're focused on the gas that's being flared from fracking, because after 400 days, it drops by about 70%. So you have to be somewhat mobile. And in order to be mobile, the generators probably, you're not going to want to exceed probably a total of maybe 3 to 5 megawatts, because if you're stacking a bunch of 500 kilowatt to 1.5 megawatt generators, and you have to move them all after 400 days, they're going to have to be somewhat mobile to get to the next pad where they're going to move the fracking to. So when you're dealing with flare gas, unless you're able to bundle it effectively, I know Caruso's focused on 1 megawatt at a time sites. I think that the constraints are probably for when you're dealing with fracking sites rather than standard drilling, you're looking at 3 to 5 megawatts per site. And that hurts the scalability somewhat, because you can't do 25 megawatts, 100 megawatts per site.
Okay. So are there other applications for using excess natural gas other than instead of flaring? So for example, for making other products, and for these applications, would the field constraints be similar as those for Bitcoin, or would they be different?
So some of the other ideas in trying to think of bringing the use to the power, could be data centers, computer server farms, places that transcode video for the likes of Netflix, which spends about $50 million a month on transcoding video. So you have to think about what could be done in a remote place and often in an inhospitable kind of environment. So there are other computer uses. Those, again, the economics are not as clear as Bitcoin is for projecting, but I do know that some mining groups, for instance, in Kazakhstan, are looking to diversify away from only doing Bitcoin mining to doing server farms in Kazakhstan. And they're actually going to try to build some power plants specifically for that in Kazakhstan. So I think it can be done. I think, particularly for some type of archival storage of computer data. But again, in order to use electricity, you're going to have to find something that can be done kind of in a warehouse with no windows, and you want to limit the number of employees because these places are not going to be so close to towns typically.
Okay, so let's shift gears here. You've got a startup, a new venture. Can you share any insights on working with venture capitalists, and what types of investments are they looking for? How much are they typically willing to invest? How much control do they seek to achieve, and how hard is it to get their attention? So basically, how do you navigate through all these issues?
So one bit of advice I have, and it's maybe seems somewhat counterintuitive, is I think you can get the meetings, but don't take your best ones early. It takes a lot of practice to be prepared for these meetings. And once you get going, you'll see the same questions are asked over and over again. And if you're not prepared, it's a quick exit. So I would hold back on kind of going to your best meetings first. Get 5 to 10 meetings under your belt before you go to the kind of what you think is the perfect investor. They typically don't want a ton of control because that would take time away from them while they're looking for other investments. You hear often that they don't care if you fail, but if you succeed, they don't want it to be just a 10x. It has to be more than that. They're looking for, the grand slams. They're looking for the 100x's. They know the risk that they take especially when they do something in a seed round or pre-revenue before you get to $1 million to 5 million. And I think there are different levels of VCs that you'll look at. Some will say, we love the idea, come back after your pilot's up and running, come back after you have $1 million in revenue, $5 million in revenue. So you have to find the right fit who are comfortable with the seed rounds. You know, that's why they're looking for the ones with the, you know, such significant upside, because they know the risk of coming in super early. Just do your homework and be prepared. These guys are, you know, are super smart. And, you know, just, again, I would not take your best meetings first is one bits of advice that I would have.
Okay, thanks. The last thing I want to ask is in sort of a similar vein is you've had experience in other, as an entrepreneur, but outside of the energy industry as well, such as in gaming. In your view, are energy startups harder to establish than other kinds of startups? And if so, why?
Well, I think there's the execution risk. I think that's the problem. This is not a small startup with just, you know, that can be run from someone's garage, right? There's going to have to be people out in the field. There's going to be downtime. There's going to be a lot of time that has to be repairs for the generators. And, you know, and if you're moving around every 400 days for fracking, there's going to be, you know, the logistics issues involved. There are a lot of people who understand energy, particularly people who are looking now at clean energy. So you're going to find people who speak the right language in terms of asking the right questions of energy. And that just even ups the kind of the pressure on you, because you're going to have to know to speak that language as well. Otherwise, they're going to notice right away that you're a novice and it's not somebody that's going to be successful. And I think that's where I have to build my team out with a petroleum engineer and not be focused just on the kind of the Bitcoin computer side. I have to make sure I have both sides covered. And then you know, there's interesting issues. You know, when I go to someone who's looking to do something in clean energy, they frown a little because of something called a rebound effect. Am I helping clean up the oil industry's reputation, which sounds good, right? I'm potentially stopping a tremendous amount of emissions coming from flaring. But some purists would say, but then you're helping the oil industry go on for a longer time, and what ends up happening with the oil that's used for, you know, for example, for our cars. So am I enabling a rebound effect to help the reputation of the oil industry? And I guess my response to that is let's stop the flaring first and worry about that second. But not everyone agrees, so it's difficult.
Okay, well, thanks, Dan, very much. We've come to the finish line for today, but this has been quite interesting. For those of you who would like to continue dialogue with Dan, please visit the Forum 2100 website for his contact information. This session has been recorded and we will be archiving it on the Forum 2100 website and also on the Forum 2100 YouTube channel. We'll make sure we put a picture up so you can really see what flaring is all about. We'll put it up on the website. Our next session will be on Tuesday, the 28th of April, and our guest will be Dr. Jan Dash. Jan is a physicist. Among his many experiences over a long and illustrious career, he has served on the research staff of CERN in Geneva, Switzerland. In recent years, though, Jan has shifted his focus to climate risk analysis. He too, he too is an entrepreneur, and he'll be talking to us about his startup, Climate Change Academy of Risk and Opportunity. Please join us on Tuesday, the 28th of April, and pass the word. All are welcome to join our sessions. Dan, thanks again, and thanks to all of you for joining us today. Until the 28th of April, Dave Nagel and I wish you well. Bye for now.